Welcome to the deep dive. You know, the world of finance, it's moving incredibly fast, especially where crypto and traditional markets are starting to blend.
Yeah, it really feels like you need a map just to keep track of what actually matters.
Exactly. And that's what we're here for, to cut through the noise, find the signal. This deep dive comes to you from the Defiant Podcast, a service from Defiant at Milton, the lifestyle sports brand building on chain.
Think of us as your analysts, really. We dig into these complex changes so you get a clear picture of what's driving things.
So today we've got some really interesting stuff lined up. We're looking at everything from, well, potential state policy shifts in the U.S. to what the big financial players are cooking up.
And the goal isn't just reporting the news, it's understanding the why. Why is this happening now? What could it mean long term?
Let's dive right in then. First up, Arizona. There's this Senate bill, 1025, the Bitcoin Reserve Bill.
That's the one passed the legislature, and now it's just waiting for the governor's signature. Or veto, I suppose.
Okay, so let's unpack that. Could Arizona really be the first U.S. state to hold actual Bitcoin in its treasury reserves? Is this, a big deal?
Oh, I think it's potentially huge. I mean, think about what that signals. A U.S. state treating Bitcoin not just as speculative tech, but as a potential reserve asset.
Right. It suggests a shift in thinking, maybe. More institutional trust.
Definitely a degree of normalization. You start asking, okay, why would they do this? Is it trying to attract crypto businesses, a diversification play, or something more philosophical about decentralized assets?
Yeah, good questions. And if Arizona does go ahead, what happens next? Do other states jump on board? Maybe states with totally different politics or economies?
That's the domino effect question, isn't it?
And does it maybe ramp up the pressure on the whole national discussion, like about CBDCs or digital reserves at the federal level?
It could absolutely fuel that conversation. It touches on the fundamental nature of, well, what is sovereign wealth in this digital era? Are we moving towards states or even nations diversifying their reserves in completely new ways?
A space to watch, for sure. Okay, let's switch from state governments to big institutions. Coinbase. They're launching a Bitcoin yield fund. May 1st is the date, right? But it's aimed specifically at non-U.S. institutional investors.
That's correct. So not for your average retail investor in the States.
Yeah.
They're promising a return between 4% and 8% annualized.
4 to 8%. Okay, How are they generating that? What's the mechanism?
It's based on a strategy called cash and carry. It's actually fairly common in traditional markets.
Right, explain that a little.
Sure. Essentially, they buy Bitcoin on the spot market, buy it right now, and at the same time, they sell Bitcoin futures contracts that expire later. By doing that, they aim to lock in a small profit based on the difference, the spread between the spot price and the futures price. It's designed to be somewhat market neutral.
So it's less about predicting Bitcoin's price swings and more about capturing this structural yield.
Exactly. It's offering institutions a way to potentially earn yield on Bitcoin that's perceived as a lower risk than just holding it directly.
Seems pretty sophisticated. Are there risks, though? Could that strategy go wrong?
Well, sure. No strategy is completely risk-free. You could have big shifts in futures pricing, what's called basis risk, or maybe liquidity issues and extreme market conditions. But generally, it's considered lower risk than directional bets.
And what does this launch signify for the crypto space overall?
I think it shows a real maturation of crypto financial products. Offering structured yield like this, especially to institutions outside the U.S., is a big step.
So attracting more traditional money?
Potentially, yes. It could bring in significant international institutional capital that maybe sat on the sidelines before. And that, in turn, could, boost market liquidity, maybe stabilize things a bit, and just add to the overall global legitimacy of crypto finance.
Speaking of legitimacy and global reach, let's talk Mastercard. Big news there.
Huge news. They're actively integrating stablecoins into their payment network. USDC is one example they've mentioned.
And this isn't just testing, right? It sounds like they're building operational infrastructure.
That's the key point. Moving from pilot programs to, making it work in the real world. This lets consumers potentially use stablecoins to pay merchants on the Mastercard network.
Wow. Okay, that feels like a massive bridge between sort of the traditional payment world and Web3.
It absolutely is. You're connecting the rails most people use every day, swiping a card, tapping a phone directly to blockchain-based assets.
And the scale. Mastercard's network is enormous. Could we see people using stablecoins without even, fully realizing it's crypto?
It's entirely possible. It could just become another payment option behind the scenes. It really signals this convergence of Web 2 and Web 3 payment systems.
So what's the timeline here? Are we talking widespread use soon? Any roadblocks?
Well, the potential is definitely there for a rapid acceleration of crypto adoption, but hurdles remain. Regulation is always a big one, ensuring clarity and consumer protection. And then there's user experience, making it seamless. Plus, ensuring different stablecoins can work together smoothly.
Still, the fact that Mastercard is investing heavily in building this, it's a powerful signal.
Undeniably. It shows a commitment to incorporating digital currencies into mainstream commerce.
Okay, let's pivot slightly within the stablecoin world. Tether, their gold-backed stablecoin, XAUT.
Right, XAUT.
The news is it's now backed by 7 tons of physical gold stored in Switzerland.
That's the claim. 7 tons in Swiss vaults. It's a pretty significant amount of physical backing.
So for an investor, what's the appeal compared to, say, USDT or just buying gold?
Well, compared to USDT, the idea is stronger, more tangible backing physical gold versus the mix of assets backing USDT, which has faced scrutiny. Compared to physical gold, it offers easier access.
Easier access.
Yeah, you get exposure to gold's price movements without the hassle of, buying bars, storing them securely, insuring them, transferring them. It's gold exposure in a digital, easily transferable token format.
Interesting, especially given Tether's, let's say, complicated history regarding transparency with USDT. Is this partly about rebuilding trust?
One could certainly argue that demonstrating substantial audited physical backing for XAUT is a strategic move to bolster confidence.
And does it point to a broader trend? Like maybe stablecoins backed by things other than just fiat currencies gaining ground? A sort of digital commodity hybrid?
It's definitely part of that conversation. Gold has always been that traditional safe haven, right? A hedge against inflation, instability. Tokenizing it makes it fit much more easily into the digital financial ecosystem. It could appeal to investors looking for diversification beyond fiat-backed stablecoins or even volatile cryptocurrencies.
Okay, let's zoom out for the last piece. A Forbes analysis looking at the bigger picture stablecoins and tokenization overall.
Yeah, their core argument is pretty bold.
Which is?
That these technologies aren't just, niche improvements. They are actively reshaping the global financial system at a fundamental level.
Reshaping how? What's the mechanism?
A key concept is tokenization. Taking real-world assets, think bonds, real estate, commodities, even currencies, and representing them as digital tokens on a blockchain.
Okay, and why do that? What's the benefit?
Efficiency, mostly. It promises much faster settlement times for transactions, lower costs, and greater transparency. Imagine trading fractions of a commercial property almost instantly, or settling international bond trades in minutes instead of days.
And stablecoins fit into this how?
Forbes highlights their role particularly in things like cross-border payments and remittances. These are areas where the traditional system is often slow and expensive. Stablecoins offer a way to move value across borders quickly and cheaply using blockchain rails.
So it's really about tackling these long-standing inefficiencies in global finance, making value transfer almost instant and low cost.
That's the potential, yes. And what makes this Forbes piece and the trend itself so compelling is who's getting involved.
Meaning the big banks.
Exactly. They mention major players like JP Morgan, HSBC actively exploring and implementing tokenization projects. That signals that even the heart of traditional finance sees this isn't just hype.
So the resistance to blockchain within TradFi might be weakening. They see the potential now.
It certainly looks that way. It's moving from skepticism, perhaps, to active engagement and trying to figure out how to leverage this technology. It feels less like if and more like how and when.
Okay, so if we tie all these threads together, Arizona considering Bitcoin reserves, Coinbase offering institutional yield products, Mastercard integrating stablecoins, Tether backing XAUT with gold, and big banks exploring tokenization.
It paints a pretty clear picture, doesn't it?
Yeah, it feels like a convergence. It's not just one thing happening in isolation.
Precisely. These are all different facets of the same underlying shift. The deep integration of crypto and blockchain into finance, from state policy right down to everyday payments and institutional asset management.
It feels, well, kind of irreversible at this point. The implications seem massive for how we all interact with money and assets in the future.
Absolutely. The potential impact on efficiency, accessibility, and just the fundamental structure of finance is profound. It's not just a tech story anymore. It's becoming a core financial infrastructure story.
And helping you understand that story, giving you the context behind the headlines. That's what we aim for here on the Deep Dive. It's brought to you by the Defiant Podcast, powered by Defiant, the on-chain lifestyle sports brand.
We hope this breakdown helps you connect the dots and see the bigger trends taking shape.
Thanks for joining us for this deep dive. We'll catch you next time.